should more jobs in the U.S. be a good thing? And so shouldn't the markets like that? Or isn't that what's going on here? Welcome to Macro Money. This is Ilya Spivak, head of global macro at tastylive. We're looking at September's jobs report today. It's that time of the month, the first Friday of every month, we get an update from the Bureau of Labor Statistics on how the U.S. labor market is doing, and that time is now. We're going to have these numbers with us tomorrow. It should be a very interesting release with a lot of market moving potential. So let's take a look at what we are going to be looking at as far as expectations to set the stage a little bit, and then figure out what the reaction function for investors might be. Now, as ever, if you're watching this on YouTube, do jump in the comments, share your thoughts. What do you think the data is going to do, not do? Do you think it matters? Do you think it's going to impact stocks or the dollar? Whatever's on your mind, jump in and share, and we'll incorporate your thoughts into the show going forward. The question we're asking here today is it actually bad for stocks if we get more jobs and if hiring looks stronger? Well, let's first see how much hiring we're supposed to get. Here are the expectations. We're looking for a forecast of 170,000 jobs added to non-farm payrolls in September. That's broadly in line, as we can see here with recent values. There's been a very gradual deceleration from early 2022, where we had a peak right around there. We can see that 904 number. That's early last year. And from there, we've kind of gradually inched lower as the appetite for labor has cooled just a bit. Now, what we tellingly see here is it hasn't actually turned into layoffs in any kind of a mass way, because the unemployment rate has been idling at very, very low levels, basically between 3.4 and 3.8%, which is consistent with the lowest levels in 40, 50 years. So we're looking at continuation here for the most part. If we look at these expectations, the number at 170 marks a little bit of a climb down from 187 in the prior month, but nothing dramatic, nothing eye-wateringly scary. And the unemployment rate is seen inching down just a bit from 3.8 to 3.7. So broadly in line with expectations would essentially amount to status quo. Now, there's been a slew of economic data this week to form these expectations and to suggest what the outcome might be. Now, first and foremost, the ISM economic activity surveys came out, and here we have the employment component of both manufacturing and services, and we can see that for the first time in 3 months, both are in positive territory. This works on the same logic as PMIs, where above 50 is growth, below 50 is contraction. The further you go above, the faster the growth. The further you go below, the faster the contraction. And so what we see here in a very interesting way is that the manufacturing component has jumped back over 50. In other words, this is the first time that we've seen both positive hiring growth in services and positive hiring growth in manufacturing in 3 months. That would suggest that we're probably looking at a fairly good report. Leading into this was the JOLTS job openings report. This is for August, but this is a lead-in to September's numbers, right? Job openings need to occur before people fill them. And what we see here is the numbers came out much better than expected. The July number was revised up from 8.9, or to 8.9 rather, from 8.83. And the August number came in much higher than expected, 7.6 million versus the 8.8 expected. So there was a lead up of increasing appetite to hire going into September, and the ISM numbers seem to suggest that September was a fairly good month for hiring. Looking at the jobless claims numbers that just came out earlier today, we can see that the weekly claims number has absolutely cratered in September. This is what we're looking at right here. Sharp move lower in initial claims, well below the 4-week average, which is the trend on a monthly basis, well below the 12-week average, which is the trend on a quarterly basis. So what we're looking at here seems to be a significant reduction in people applying for unemployment benefits. That would suggest that the job market is absorbing people that want to work. And of course, it would also suggest not a terribly high amount of layoff activity. Looking at continuing claims, much the same thing. Possibly even more supportive, because what we're looking at here seems to be a situation where those people that are continuing to claim benefits because they're still trying to find a job, that number has been coming down, meaning those people are being absorbed into employment, i.e. hiring is occurring. All of which would suggest that indeed in September the labor market looked fairly good. Now, we did get one fly in the ointment here. The ADP estimate for private sector hiring was, to put it lightly, a pitiful number at 89. That's, of course, a disappointing result. Expectation was for 150, and the contribution from private payrolls into that 170K number that we see here. So the part of this number that's the private sector is expected to be 158. So not surprisingly, the majority, but well over 89. So these numbers from ADP, not at all encouraging, but this is only one piece of leading data, and ADP tends to be really volatile in its relationship with the official jobs report. So this perhaps deserves to be taken with a grain of salt. What we can see is that on the whole, U.S. economic data has tended to surprise north of expectations and has cooled a little in its ability to do that here, August through September, but has clearly stabilized here. And what we see is still readings well above zero. And of course, when this index is above zero, that would mean data is tending to surprise higher relative to forecasts. Below zero would be tending to surprise lower. Now, level changes, so degrees by which momentum is able to carry forward and give us higher numbers versus lower numbers, that matters, because this index is scaled by reactivity in markets. So if a release surprises and that surprise is market moving, that gets you a higher value of this index. So the capacity for good data to move markets is a factor here, and it does matter that this index has come off the high and has seemingly anchored a bit here, but it does still speak to a situation where the surprises tend to be on the upside. What's more, this anchoring seems mostly linked with a shift in expectations, not in economic data. So if we look here, we can see from mid-August, there was an upshift in expectations for U.S. performance. So U.S. GDP forecasts, as put together by a survey of analysts polled by Bloomberg, that showed an increase in expected GDP for this year, an increase in expected GDP for next year. Notice this is mid-August. What do we see in mid-August? We see this index come in a bit. So it isn't so much that the data has deteriorated, it's that the bar to beat forecasts has been lowered or raised. And in this case, it's been raised because expectations have been adjusted higher. So by all accounts, we're still in a world where, on balance, we are looking at a situation where U.S. economic data tends to surprise higher, and there is far more compelling evidence that this NFP number is going to surprise that way than the other way. That doesn't mean that it can't surprise on the downside, of course. Just look at ADP. But the preponderance of evidence and the recent dynamics in data flow relative to forecasts, all of that together seems to suggest we are much likelier to have an upside surprise in this jobs data than a downside surprise. Now, what does this mean for markets? Well, since we've had all of this news flow related to jobs this week, we can actually have a very good sense for where the market reaction function is. How did the markets perform when we saw that higher than expected JOLTS number? Well, this is the S&P 500 E-mini future, the ES contract. We can see how the overall market saw that. They didn't like it. More job openings and the market went bad. Midweek, the ADP number, we can see popped higher on ES when it came out. Things got a little bit muddy because sheer hours later, we get ISM, which, as we just saw, pointed in the opposite direction. And so there was a bit of back and forth here, but of course, the optimists prevailed. Bad number, good for stocks. Good indications, not so good. And of course, today, jobless claims. Much better numbers on jobless claims, as we just saw, and what do we see? Stocks don't like it. All of which would suggest that if we were to get NFP numbers, or indeed the jobless rate number, registering better than expected, or some combination thereof, if investors walk away from this report thinking, well, that was a better report, the U.S. labor market is more resilient on balance than we thought. Well, that seems to be bad news for stock markets in this current way that things are working. Now, of course, these relationships ebb and flow and change, and this is why paying attention to macro dynamics is so important. They're not static. Context matters. And in this case, the context is being offered by a look at where the global economy is writ large. And of course, we just got the end of the September reporting cycle for purchasing manager indices, which are a really great and timely approximation of where GDP goes. GDP numbers are typically only reported quarterly and with a terrible lag. So actually trying to see where you are in the business cycle with GDP numbers is a bit of a lost cause. The PMI numbers come out monthly and are a very good GDP leading indicator and a very good sense of where you are in the business cycle and where you are in growth before GDP numbers catch up to actually show you the same thing some months later. And what we see here is the global economy writ large, as of September, is growing at the slowest rate since January. There's been a very significant deceleration in global growth after the global service sector peaked in the first half of the year. It was the first quarter or the second, depending on where you look. If it's China, it was earlier. If it's the US or Europe, it was later. But we saw a very clear reversal in the second half of the year. Services deflating, manufacturing still stagnating, and so overall global growth coming down. At the same time that this is happening, the Federal Reserve does not want to cut interest rates. And of course, it's the Federal Reserve that matters and the one that the markets are pining to do something, because it's the Fed that has the ability to move global borrowing costs and no other central bank. Certainly not with anything like equal ability. And that's because overwhelmingly most global monetary transactions are settled in US dollars. According to the Bank of International Settlements, it's something to the tune of 88%. Which means that when you increase the cost of borrowing dollars, when the Fed hikes rates, that doesn't just increase borrowing costs in the US, it increases them everywhere, with the perhaps tiny exception of a place like North Korea, let's say, which is completely cut off from the global economy, or almost completely. So those kinds of edge cases aside, when the Fed raises the cost of borrowing dollars, it's raising the cost of borrowing the quintessential medium of global commercial activity, which means it is raising the cost of borrowing for any kind of commercial activity, corporate, individual, household, investment, you name it. And of course, when the Fed cuts, it makes all of that economic activity cheaper to finance the whole world over. So when you look at this and you say the global economy is growing at the slowest pace in almost a year, it's not surprising why investors are yelling uncle and pining for the Fed to ease. But the Fed doesn't want to. The reason the Fed doesn't want to, as we've just heard from their latest update in September, is because there's still a ton of inflation locked in the service sector, and the only way it knows how to get it squeezed out is by hurting the economy, reducing demand, and bringing prices down. Part of that, surely, although it is perhaps unsaid, is to keep borrowing costs high enough that demand is squeezed, and that goods component of CPI that you see here, the orange one, now that it's been squeezed to next to nothing, that it actually turns negative. And with an economic downturn, you'd get that, because that would start to hurt demand for goods, among other things. But of course, the biggest component here, and the thing that the Fed has to be focused on most acutely, is services, because clearly that's where most inflation lives at this point. Now, the majority of it is locked in the housing component of services, and that's to a large extent the Fed's own fault. The brisk rate hikes we have seen have pushed up mortgage rates aggressively, and that's kept housing from falling in price. Average outstanding interest rate on mortgages in the U.S. is locked in, typically for 30 years, and the current average is 3.6%. After the Fed's rate hikes, the market average is 7.6%, which means if you were to sell your house and go and try and finance the purchase of a new one, you'd be paying 400 basis points more on average than your current mortgage. Is it any surprise that nobody wants to sell? And is it any surprise that people are trying to stay within their homes and so repair them and find a way to somehow make it the livable situation that they need, rather than to trade up or to trade in general? So not surprisingly, housing prices have not fallen. Most U.S. housing transactions are in existing homes, not new homes, by far. Existing home inventory has collapsed to next to nothing, barely 1 million homes. And so what we're looking at mostly in the service sector won't be undone until the Fed cuts rates, lets those mortgage rates come down, and lets that market clear a bit. But where the Fed can have agency to start the process is the labor market, the other place where costs are locked. As we can see here, inflation has come down by multiple percentage points, whether you look at the numbers in CPI or you look at the numbers in PCE. In PCE, inflation has been halved from the peak. In CPI, it's been more than halved. The employment cost index in the yellow there has fallen by less than 1%. And the reason for that is we still have a meaningful deficit in the labor market. Now, when something is in deficit, when more people want a thing than there is of the thing, what happens? The price goes up. Because the people that want the thing start to compete for scarce supply. Not surprisingly, this has been an uplift on wages. And of course, it was much more of an uplift on wages last year, but wages don't adjust down with higher Fed rates here. Just because inflation is coming down does not mean that wages are going to get now renegotiated. No, that typically only happens if there are layoffs and people have to get new jobs now at a new wage structure. And so from the Fed's perspective, where it can still have agency to bring inflation down toward their goal is to squeeze the economy, as we just said, first, to get the good side to turn negative, but much more importantly, to get the right amount of squeeze applied to the labor market that wage inflation is squeezed out, at least to some extent. Now, since you can't make more labor supply out of thin air, hurting labor demand becomes the only way to square this circle. And until you do that, says the Fed, they're going to hold rates at these relatively high levels, even as a global recession starts to get ever closer, even as the market is pining for assistance in the face of that recession. We can see that in spades here. As rate cut expectations between now and the end of next year have become more modest, stocks have fallen. This reflects the idea that the Fed is probably not going to raise rates in November and December and is going to cut them next year. But on net, from now, the last two meetings of this year, November and December, through all of next year, through December of next year, the cumulative amount of policy change for the Fed is now seen as just about, give or take, 75 basis points in cuts. As recently as 2 months ago, it was more like double that. And as we've made that adjustment, as the scope for rate cuts has been reduced because the labor market isn't budging and the Fed is intent on holding these rates higher and delaying easing, stocks have fallen. Because the growth backdrop has investors wanting the easing. And the Fed is not letting them have it. At the same time, the U.S. dollar has moved higher, both because its yield profile has been improved by fewer cuts and because the move down in stocks has encouraged a cashing out of risky assets, and the most liquid and thereby the most attractive form of cash to do that is the dollar. So if we are tilted to an NFP number that surprises higher, if that's how we are perceiving the likely balance of risks, then we are perceiving a balance of risks that suggests the message for the Fed out of the data will be, not yet. Keep sitting on your hands. And the message for markets will be, we're not getting the help that we need even as recession nears. And the story in markets has been this very thing has been negative for stocks, positive for the U.S. dollar, and more of the same may well be what's on the menu if indeed this jobs data surprises higher, as seems to be the expectation from the various tea leaves that we've read here. And that is Macro Money for today. It is also the last show for this week. We are here Monday through Thursday every week right after overtime, a show that I co-host with Chris Vecchio, head of Futures and Forex here at tastylive, where we try to figure out what's going on after the Wall Street close and then see what that means going forward. Dylan Radigan increasingly joins us for that show. Always a lively discussion. I am also on with Chris tomorrow after NFP to pick through what has occurred for Futures Power Hour. I'll be on with Tom and Tony for First Call on Sunday. I'm writing for the News and Insights section of tastylive.com, where you'll find a summary of this very analysis already. And I am sharing my thoughts sporadically on the platform formerly known as Twitter, at Ilyas Pivak. Thanks very much for joining. Happy trading. Macro Money will be back next week, and I'll see you tomorrow for Futures Power Hour. Take care.